Morning everybody and welcome to the Aquila Markets macro update this morning on Friday the 9th of April. A lot to get through today, so let's get going. So our theme for the last for a long period of time now, many months, has been this idea of reflation. Higher global rates, stronger dollar, extraordinary amounts of stimulus was going to create this massive rally in equity markets, but a big move in the bond market as well, lower yields, really driven by this extraordinary amount of stimulus and incredibly accommodative central banks. And we've really seen that as the vaccines have started to really play out. It's really worked. But I think one thing we really want to focus on is that in the last couple of weeks, this reflation theme has really paused. Rates have moderated, the stronger dollar move has really stopped, and we've entered into what we call a Goldilocks scenario. Market's not too hot, it's not too cold, and it's allowed risk assets to blast its way to the top side. And we can see this really clearly. If we just look over the past week, we can see this big move lower in the VIX. The break lower in vol is a classic signal. This 20 level has been massive in VIX in order for this Goldilocks scenario to really play out. And what we've seen in lots of markets is this concept of churn and chop, and lots of conversations we've been having around people trying to understand quite what's happening in a lot of these markets. The issue for us is that this Goldilocks scenario is not sustainable. The porridge didn't stay at the right temperature forever, and the bears did come back and Goldilocks had to run away. The key, of course, for that is timing. And really for us, underneath this market, which you feel is kind of complacent, there's so much geopolitical risk growing. This vaccine nationalism story looks like certain parts of core Europe are potentially going to go to Russia for the vaccine, which is extraordinary given the fact that we've got troop build-up from the Russians in Ukraine. The tensions in the South China Sea are not going on. We have this coup in Myanmar, and we have the violence in Ireland. And Ireland really has been at the core of the issue around the Brexit negotiations as to how to resolve the land border between the south of Ireland and Northern Ireland and the sea border between the UK and Northern Ireland, and it's not really been resolved particularly clearly. And I think that's one of the reasons why the issues that exist in a place like Ireland are always there under the surface. But let's just come and see quickly on the dashboard, and one of the things I want to point out is the big performance in the Nasdaq, tech outperformance, the performance in the FTSE. We think the weaker pound has probably helped that a little bit. But the lower vol in FX here, and the lower vol clearly through the VIX situation. If we come and look at the sector dashboard, tech is suddenly resuming its outperformance relative to growth. Look on the month. Growth is up 11% against value up 2.8%. That is big cap tech. And we've been pointing this out repeatedly. The Googles, the Microsofts, the Amazons, all these guys just breaking away. Facebook's to new highs. Big moves in all of these stocks. And if we come down here and look at the sector performance, technology, consumer discretionary, semiconductors, and the weakest links, energy and oil and gas. This is the anti-rotation trade back to the growth leadership. But check this out. Let's come and look here at the equal weight index versus the market weight index. See how market weight is really outperforming here very, very clearly. And that is always a very interesting sign when we see this, because it tells us that leadership is really narrowing. So we've got a narrowing of leadership. We've got the market grinding to the upside. We've got this big fall in overall market trading volumes. But at the same time, we're getting record inflows into ETFs. Retail stock option demand has really fallen off since January. In other words, this is not a stock market with good internals. It's a narrow rally on lower volumes and a change in the way in which the market is starting to see views being expressed. This is not good market internals. But interestingly, when we come and look at our radar screen, we have no real changes on the trade side. We have nothing in equities at the moment. That's because we're keeping our powder firmly dry on the equity side. But one thing we can notice is Apple breaking to the top side. Okay, that's a that's that tech signal. Dollar-MEX breaking its supports at 2020. Okay, that's because of the VIX, this correlation that we talked about yesterday, correlation between the VIX and Dollar-MEX. So what we're really starting to see is this play starting to, this momentum story starting to play out of, is it the end of the reflation trade? And we really don't think it is, because when we come and look at the market map and question to ourselves, how long can this Goldilocks scenario really play out? We can see the Goldilocks scenario really clearly. Here's the move lower in rates. This is 5-year rates in red. Lower, we can see that since the beginning of April. We can see that oil's been consolidating now for several weeks. There's the move lower in the dollar since the end of March, and equities, bang, blasted their way to the upside. But notice, not only have we got a fall in equity volumes, The put-call ratio, in other words, the demand for puts over calls within the S&P, is at a 4-year low. It means nobody wants any puts. They don't want any downside protection. And we can see that from the VIX. The AAII Investor Survey bulls is at 4-year highs. In other words, we've got a low volume, narrow rally with complacency. This is not sustainable. We just have to recognize that this is not a sustainable equity rally, and we need to really be on alert. So one of the things I want to point out today, and we talked about this yesterday, that we're going to talk about this today, is to talk about real yields. Real rates are just the yield on Treasury inflation protection securities, TIPS. And TIPS are just bonds. You can buy and sell them. We can all just go and buy this stuff. But what's fascinating to us is the relationship between real rates, and real rates, of course, we can also define as the gap between nominal bond yields, how much you get on a bond that you buy, and inflation. So as we go back all the way back here and look at the red line here, this is real yields up around 1%, look, back in 2018. That tells us that our bond yield, which at that point was around 3%, was around 1% higher than inflation. So we got a positive return relative to inflation back here in 2018. But note this. This started breaking down at the end of 2018, and we obviously have been talking about this slowdown through 2019 for the global economy, driven mainly by the China-US trade war. But notice what happened to equities. Equities then began to rally. Obviously, there's the big, massive COVID sell-off. We can see that here in blue. This is the S&P 500, before blasting to the upside. But look at the suppression here of real yields below zero. Remember, zero is where your nominal bond yield equals the inflation rate, i.e. you get no return on bonds relative to inflation. But look how it has been suppressed for the last year, and not just suppressed, but kept extraordinarily negative. So let's look at something else. Why has that been happening? Or what are the reasons for that? And we mentioned this a long time ago, it's a theme we've come back to, is the Fed has been buying TIPS very aggressively. It's been buying them hugely. We can see it really clearly here. This is the percentage increase of the Fed's holding in TIPS. Remember, TIPS are just bonds. It's gone from 8% to 21.1% of all the holdings of TIPS are held by the Fed. So what are the Fed doing? The Fed are buying all these TIPS, and what does that act to do? It keeps yields down, keeps real yields pushed down. Now, inflation expectations that people keep talking about are just nominal rates minus real rates, okay? So if you keep the real rates really suppressed and we get nominal rates going up, what happens to inflation break-evens? They go up too, and we can see it really clearly in the lower chart. Here's the suppression in yellow of real yields kept suppressed. Here's the move up here in 10-year yields. This is the reflation story driven by the vaccine situation, started here back in November. And what does it do? It pushes inflation break-evens above 2%. Now, why is 2% important? Because 2% is the Fed's inflation target, called PCE. That's what it uses, inflation target. So what the Fed is doing, by suppressing real yields by buying TIPS, is generating higher inflation expectations. Now, the reason why this matters, of course, is that how much longer are they going to be able to keep real yields so negative by buying all these TIPS? Because what we do know is we're about to see a big pickup in inflation. We know that because of the comparisons with inflation for last year. So the CPI is going to be massive next week because the Fed keeps telling us that it's going to look through any short-term transitory inflation and not worry about it at all and focus on the future. The bond market is saying no. That's why it's pricing in all these hikes, by the 4 hikes by the end of 2023. The US bond market is saying, no, you're going to have to hike. And the Fed said, I'm not. But what's most interesting to us is how long can they suppress real yields? Because if this starts to move up, inflation break-evens, which they don't want to go down, are going to go lower, unless Treasury yields go up as well. So in other words, the way that they can maintain inflation break-evens at a higher point is to let both real yields, TIPS yields, and 10-year yields go up. And this is why we believe still in the reflation trade. We believe that reflation trade is absolutely in force, and we are going to continue to see rates with the 10-year moving up to 2%. And this is just a pause. Now, what does this mean for the NASDAQ and for risk assets in general? Risk assets are not going to perform great in that environment. They're going to go down. And the NASDAQ has been the big beneficiary of this recent move, with the move from value to growth, because this is the growth stock index. So yes, we've seen this big move. We don't like the internals. We don't like the volume, and we don't like the momentum. This rally does not look sustainable. So in other words, here we are knocking on the door of the recent highs at 140. We think this is going to make a new high in the coming days in the 14,000 to 14,500 zone. But but we do not think that rally is sustainable, and we question whether if we get bond yields start to pick up again, another rotation from growth to value as the reflation trade starts to take hold. If that reflation trade really starts to take hold, you see nominal rates moving up again, even with real yields moving up too, you are going to see the technology stocks struggle. We're going to see the dollar up, and we're going to see more of those same kind of themes that we've been seeing earlier this year. And so that's the big thought that we have. And the one final point that I want to make is about the VIX. Now, we keep talking about the VIX. Remember what the VIX is. The VIX is a blend of prices of options on the S&P 500. It's actually a measure of implied vol in general. But we've been pointing to this 20 zone. Here's the VIX here in red. You can see that we're at the lows since the pandemic, the extraordinary spike that we saw in the pandemic. The VVIX is the volatility of options on the VIX itself. It's a measure of the volatility of volatility. Now you can notice that oftentimes, notice how the VVIX turns, the blue line turns up before the red line. Again, the VVIX here was more elevated than the VIX, and we saw a spike. So we're really interested in this move back up in the VVIX off very low levels, and also the lows that we saw back in September. And we're wondering whether we're starting to see the signs of divergence here between the VIX, volatility on the S&P, and the VVIX, the volatility of the VIX itself. Yesterday in the market, there was a huge upside buy order in VIX options. This is interesting. It's actually all the way out into July, buying time. But we have to pay real attention to these flows and real attention to what the market is telling us. The market is telling us that this rally in the Nasdaq may not be sustainable, and we could be setting up for some tremendous counter trend plays with a big pickup in vol. So that's our theme for today. A lot in there today. Go back, look at the chart. Please read all our disclaimers at aquilamarkets.com and viewing any of our content. That's it from us. Have a great weekend. Take care, everybody.